drive active. Warp drive active. Warp drive active.
Hey, Ishtar. Probably can't kill it. But we'll make a little attempt.
Warp drive active.
Oh, my prop mod is actually offline on my interceptor.
Warp drive active.
Yeah, what do we turn off? I guess I don't, maybe I don't turn off anything.
Warp drive active. Warp drive active.
Oh my god, I just jumped through the gate like an idiot. I meant to orbit it.
Warp drive active.
Let's open Python. I have the interdiction nullifier here, but I should have the compact interdiction nullifier instead. Wall? The Squall is a Sino ship. I think so. Overt Sino ship. And also industrial ship, I think. Right, so do multiple things. Override dynamic music with classic Eve music. This should give us that Eve music that we know and love. It's not doing it. What the heck is the point? That freaking playlist. pretty close to giving up on getting the classic Eve music. I suppose I could always just open a playlist to get it into the game. It's not like it's dynamic music, so you just play it off some different program. By the way, I've shared my bookmarks now.
Web drive active. Web drive active. Web drive active.
There's Delugeous in here. No idea if this is a trap or not, but we'll just have to try accepting it.
Web drive active.
Black Flag declares war against Sigma Grindset. Yeah, I'm soon done with every single skill that takes less than 1 day once I'm in my training pod. It's available to my character at all. I would say I am now a well-rounded character, but not a highly skilled character. I have a little bit of everything now. I can fly maybe half of the fits out there. he escaped, but he left one of his ice mining drones behind. We'll kill it. Oh, there's a Proteus. Somebody showed up in a ship called Prospect FT, whatever that means. FT, something fast tackle? What? Bar tackle? I don't know.
active. Connecting.
This is my spam mail guy. I send the spam mail from. You get recruits and investors. Whenever you get a response, it's not good because it's just people trying to counteroffer you. I have a feeling you're trolling me. Oh, too bad. That was not trolling. Alright, we're gonna give it a few minutes. Let's choose a random amount of time. We'll go in increments of 5 minutes. Ten minutes. Yeah, it's gonna be 10 minutes. So 10 minutes from now, we're gonna log in. Let's see if we can get him.
There to Ed, have you ever had sex at a music festival? No.
Business. Like this. You know if you go. Use side. You wait. That did. Hold back. So. That's the There is no. Let me ask.
Alright. Let's log back in. Alright, so the plan is what is it? I log in on the interceptor and then once I'm logged in I tackle and I fleet invite the other guy.
Connecting.
Ah, there he is. It warps off immediately. Yeah, he knew I was gonna. He was ready. That guy was ready to escape. It didn't work, but he was at the belt, but he was alert. He was ready. Good try though. There was an Ishtar here briefly, but I didn't. It's gone now, but it was doing some kind of nearby site. Yeah, now there's a Proteus here. And an Endurance. Now the bait's gonna come. We're not gonna take that bait. Well, I guess we can just keep watching the podcast, I guess.
And I think that we're going to have to keep an eye on over the next couple of weeks. But there is no doubt that the people
These
who
are
getting hit
news,
hardest
but
here
they're 2 weeks
are
old,
the
so
small
they're
to
they're
medium-sized
actually not
businesses,
news
the very
anymore.
businesses that Trump said he would bring back to life.
I haven't heard anything you said since you used the term candle in the wind. Jesus Christ, you're so Princeton. Let me.
Yeah, I went on a bit of a StarCraft 1 binge, Artosis cast, so I'm like 2 weeks behind on my current affairs YouTube backlog, so it's a bit weird.
Ask you this. Do they make that university for a man? Do you think any of my colleagues from UCLA have ever used the term a candle in the wind?
Let's talk about what's happening to the dollar here. Dollar hit a 3-year low last week against the euro. We've talked before about how unusual it was that after the tariffs, we saw the stock market go down and the yields on treasuries go up. And that's strange because usually when stocks go down, as much as they did last week, you see this flight to safety, which means that investors start buying into treasuries, which brings the yield down. And instead, we saw the opposite. Yields went up, which was an indication that the investment community believed that treasuries were not safe. And that's very rare and very alarming, as we discussed last week. So what's happening to the dollar right now is the same dynamic, but to the power of 3. Because in the same way that when investors dump stocks, and they usually buy treasuries in the same way that that's the common dynamic. When investors start dumping treasuries, usually what happens is they go and they buy dollars, because for governments and for large institutions, the dollar is generally considered to be the ultimate safety asset, safer than stocks and even safer than treasuries. And we can talk about gold and we can talk about Bitcoin, but throughout modern history, this has been the dynamic. What we're seeing this week is once again the opposite. The yield is going up and the dollar is going down. So investors are dumping their dollars. They are converting into other currencies. They do not consider the dollar to be a safe investment. And so this is a continuation of what we discussed last week. We're now seeing a flight away from the US stock market, away from the US Treasury market, and now away from the US dollar. So from top to bottom, from stocks and all the way down to dollars, the world is essentially selling America. And the implications here are, again, enormous, because if this continues, if everyone keeps selling their dollars, then we will lose our position as the world's reserve currency. And you ask anyone who knows anything about economics, they will tell you our reserve currency status is basically the number one reason our country is as powerful as it is today. And it's been described as the exorbitant privilege. And we can get into why it's so useful. The long and short of it is it makes borrowing a lot easier and a lot cheaper for us. But if we lose that, and now people are beginning to talk about that, you saw.
Yeah, it makes America powerful, but that power comes at the cost of the American people as well as the German and Chinese people and all the workers of the surplus countries. So that power is just for the people who work in the government, the elites essentially, or the foreign policy apparatus. But not in normal people's interest to have, like, not even in the interest of Americans, the American currency to be the reserve currency. Common mistake.
Well, that quote from the chief investment officer of JP Morgan, this could be the end of American dollar exceptionalism. If we lose that, then America is really in trouble. We're not there yet, but I just want to explain that this is the direction we're seeing. This is the conversation that investors are beginning to have. And yes, it is on the table.
If people lose faith in our company's ability to pay money back, they're less likely to loan us
There's
money.
a fly catching system.
And the government have to increase the interest rate they offer to people who loan us money in order to justify the increased risk. So our costs go up. And at the same time, our remaining dollars, have less purchasing power overseas. So our costs go up and our purchasing power goes down, both in terms of the interest rate we have to offer and also just the remaining dollars we have even after that become worth less. So that's a reduction in prosperity. That means we're no longer going to Universal. We're going to Knott's Berry Farm or Kings Island. That means we're no longer have 10 gifts under the Christmas tree for our kids. We'd have 8. And if these tariffs hold, given that 77% of toys under the Christmas tree are about to double or go up 2.5x, then you're talking about 4 gifts under the Christmas tree. So this is an immediate decline in prosperity. When I moved to London, one of the reasons I wanted to buy in London was I wanted to diversify out of the dollar. I thought, okay, I'm going to have some money in another currency. And of course, the moment I did that, I think I bought my place and I converted dollars at, I think, $1.26. and then immediately went to $1.10. I remember moving in and thinking, this house is worth 15% less than I paid for it 30 days later. Now it's back to $1.32. And I like the idea of having some assets in foreign currencies. And it just goes back again to this notion of diversification. But the way you grow an economy is you're able to borrow more than deposits on hand, right? You can borrow $120. A bank can borrow $120 from depositors and lend out $150, because as long as they don't ask for it back at the same time, you kind of have this great leverage, and you can lend more than you would if you were just only lending the money that's been provided to you. And basically, the U.S., because it has the lowest interest rates and the most trust, has the lowest cost of capital in history, meaning we can be more aggressive. And so when the cost of that capital goes up, much less the cost of human capital, think about how difficult it is to get people to come here now. I mean, people just don't need this shit.
Let's move on to this third headline here, which is these big bank earnings. We had earnings from JP Morgan and Bank of America, all the big banks. And just by the numbers here, it was a great quarter for the banks. JP Morgan beat on estimates. Their profits rose 9%. Bank of America also beat, profits up 11%. Goldman Sachs beat, profits up 15%. Citigroup beat, up 21%. Morgan Stanley beat, profits up 26%. I mean, huge, huge quarter, incredible quarter for these banks. And as usual, they're all kind of telling the same story here. And this is generally what we see in banking. It's a very cyclical business. Whatever's going right or wrong at JP Morgan is usually the same thing that's going right or wrong at Bank of America. Last year it was this rise in net interest income. The year before that, it was this downturn in investment banking, et cetera, et cetera. So what is the theme today? Well, it's actually something we predicted, and that is that trading revenues, the money that these banks make from facilitating and executing stock trades, that business is exploding. It was a record quarter for most of these banks. For Morgan Stanley, the trading revenue was up 45%. And the reason this is happening is volatility. The administration is causing chaos in the markets, which is causing investors to reshuffle their portfolios. They're buying and they're selling, and the banks are profiting off of that. And this is what I said way back at South by Southwest. The people who are being rewarded here are not the value investors. It's not the people who are investing long-term into the real economy in America. In fact, they're getting burned. The people who are winning in the stock market are the traders, the gamblers, the speculators. It's basically the people who want to make a quick buck off of volatility. Scott, your reactions to what we're seeing from the big banks?
Very simply, when there's tumult in the market, people want to take moves. The company says, whether it's Mercedes that wants to hedge its exposure to the dollar, or whether it's a company that needs to come up with another $100 million to offload their products, they're going to have to pay a tariff on they weren't expecting. They have to either raise money, go to a bank, or a consumer says, I freaked out about this. I'm retiring in 2 years. I'm going to take down my equity exposure. I'm going to sell stocks. But anything in the news like this just creates more urgency and more action and just more trading. I mean, everything we're talking about in terms of diversification, all the moves require a certain, or induce, if you will, a certain level of action. What we've been saying is don't do panic selling. And there's friction in that activity in the form of commissions and trading commissions for investment banks. So whenever there's activity like this and tumult in the marketplace that inspires a lot of actions, buying and selling, just the volume of commissions go up. In addition, there's going to be more exotics and more derivatives and more margin and more kind of sophisticated trading vehicles that clients and corporations will call on. They'll say, I'm worried about the U.S. market. Can you hedge my dollar exposure? And those types of products tend to have much higher margins. In addition, that sense of urgency, quite frankly, creates pricing power on behalf of the provider, specifically the bank riding those types of vehicles. Calm as she goes, steady as she goes is not good for these guys. I mean, in terms of trading, because there's just less trading and less sophisticated kind of vehicles that are lower margin. So, when the bullets are flying, these guys are the arms dealers. But the only thing I would argue is that I think it's a sugar high, because I think this is probably suppressing a lot of kind of systemic capital raising, like IPOs, debt market offerings. I would think M&A has kind of come to a standstill. No, the price discovery here is really difficult. What do you pay for something? Well, the buyer's going to think, oh, it should be 20% less expensive than what I offered you 30 days ago. And the seller is like, no, I'm not buying that. So I think this is a sugar high. I don't think this is going to last for these guys.
That's another argument for why today as a bank, you have to be massively diversified in terms of your businesses, which is why JP Morgan has been such an outperformer. When we see a downturn in M&A, they have a huge trading desk and they can generate and make up for it in times of volatility like we're seeing today, and they make the money off of the trading. And then, in calmer times, they'll make their money off of the interest. So the banks will be fine, especially the larger, more diversified banks. And in this case, the banks are winning. But I just do want to just re-navigate us to what Trump's promises were, and also to whom those promises were made. this was all supposed to be a win for regular people, for small, medium-sized businesses, for Main Street, for 401k holders. And again, what we're seeing here with these bank earnings, the dynamic we're seeing is actually the reverse. The winners here are the traders on Wall Street. The winners here are the people who are clients of these big banks who can afford to give them a call and take advantage of all of those exotic instruments that you just talked about that generate that higher margin. The losers here are regular investors on Main Street, the people who get no benefit from markets going up and down and up and down and up again. You know, there's no benefit from having a volatile market if you're a long-term investor who simply has their assets in a 401k and it's invested in the S&P. At first, it looked like Trump was just kicking both Wall Street and Main Street in the stomach. What we're seeing over the past week is that he is bailing out or figuring out a way to make his rich friends happier than they were before. But meanwhile, everyone else, all the regular people, they're going to get burned. And just one interesting note, Goldman on their earnings, they didn't mention the tariffs once. They didn't say the word tariff a single time. I think they probably want to position themselves as calm and unfazed by what's happening. But I think you have to assume that they probably are, to an extent, also actually a little bit unfazed by what's happening. Because I think they have this backstop that regular people don't have, which is that volatility can be a boon for them in the form of trading revenues. And that's what we saw this last quarter.
It's funny, my interpretation of that was it's a giant reach around to Trump, that they don't even want to engage in the argument and they're worried about his wrath. So they don't use the term. They just talk about volatility rather than saying the ass clown has created economic uncertainty for all of us. I mean, I know David Solomon. I like him a lot. I think he's a great leader. I am incredibly disappointed across all corporate leaders who all wake up every morning, look at themselves in the mirror and say, hello, Mr. President. I bet 498 of the 500 Fortune 500 CEOs think there's a non-zero probability they should be president, that they're so fucking awesome that they'll be drafted to run for president. And the key attribute of a president is leadership. And leadership kind of comes down to one basic fucking thing, and that's doing the right thing even when it's hard. And none of these guys are doing the right thing because it's hard to call out just how ridiculously damaging this is to America. There's such a lack of leadership across our Fortune 500 CEOs. We keep waiting. Everyone assumes that, you know, our corporate leaders are the best in the world. They're the best in the world at making profits. They have not demonstrated themselves to be great leaders.
We'll be right back. And if you're enjoying the show so far, be sure to like and subscribe to the Prof G Pod YouTube channel at the link below.
Support for the show comes from Grunes. If you're looking for a new tasty nutrition solution, then look no further than Grunes. It's a convenient, comprehensive formula packed into 8 gummies a day. Grunes isn't a multivitamin, a greens gummy, or a prebiotic. It's all of those things, and then some, at a fraction of the price. Their daily packs contain 8 gummies because you just can't fit the amount of nutrients they do just into one gummy. Generic multivitamins only contain around 7 to 9 vitamins, but Grunes have more than 20 vitamins and minerals, plus more than 60 whole food ingredients. They actually provided us with a bit of science to explain what makes Grunes different. Basically, 30% of the population has a gene that messes with how they absorb vitamins. But Grunes is methylated, which is a fancy way of saying their vitamins like B12 and folate can be absorbed by your body. Methylating is an expensive option for a lot of other companies, but Grunes is looking out for you. Plus, they're vegan and free of nuts, dairy, and gluten, and they're made with no artificial colors or flavors. Get up to 45% off when you go to grunes.co and use code PROFG. That's GRUNS.co, using code PROFG for 45% off.
Welcome back. Here's our conversation with William Cohen, New York Times bestselling author and founding partner of Puck. Bill, thanks for coming on.
Great to be here. Thank you for having me again.
So we talk a lot about the stock market. I think everyone talks a lot about the stock market, especially on this show. We talk a lot less about the bond market, which, despite being much larger in terms of just asset size, I think is quite misunderstood compared to the stock market. So we wanted to have you on today to talk to us about bonds. You've been writing a lot about the bond market in the past couple of weeks. What we saw last week was a fluctuation in yields. We saw this explosion in the yield on the 10-year, and this was the thing that everyone was very concerned about. So give us an explainer on what happened to the yield on the 10-year, what happened to Treasury yields in general last week, why it's important, and why everyone is so concerned about this.
Markets are a confidence game. The financial system is a confidence game. And I don't mean that in a negative way. I mean that in a positive way. It only works if people continue to have confidence in it. The stock market is all about confidence. You know, you generally believe that a stock is going up, or else you wouldn't invest in it, or you'd short it if you believed it was going down. But you have to have confidence that the financial statements are accurate, and
order
we
slots
have an
right
SEC.
now.
We have regulators. That's why they have to file and certify the financial statements. The bond market also relies on confidence. So, When the tariffs shenanigans began, what I call the tariff palooza, began in earnest, there was an initial flight to quality, and what I mean by that is people sort of ran from the equity markets because they didn't know what the effect of these tariffs would be on corporate profits and people's confidence in the equity market and in the economy generally, whether we're going to have inflation and a recession or stagflation, whatever it was going to be. And so the initial impulse was to run to the safety of the treasury bond market. When this tariff palooza started, the yield on the 10-year treasury was around 4%, and the next day or so it rallied, and the yield fell to like 3.85%, which is relatively low, especially over the last few years. And so there was a sense that people were seeking the safety of the treasury bond market. But then once people began to realize what these exorbitant tariffs were all about and how convoluted it all seemed and how poorly thought out and how much inflation it might result in, the yield on the bond market began to move up precipitously and got to like 4.5%, which was basically the largest and quickest move up in the 10-year treasury in like 37 years. So it really shook people's confidence in what is supposed to be the most sanctified, safest market that there is.
While that was all happening, we were describing confidence being shaken. I was watching CNBC, I was glued to the TV, and everyone was talking about the possibility of a credit crisis or a credit crunch. That's sort of the end game, it sounds like. If yields explode, then it could trigger this credit crisis. Explain to us what actually is a credit crisis. What does that look like? What does it mean on a technical level? And why would it be so bad for our economy?
The whole world runs on debt. I mean, borrowings, and the availability of borrowings, lending money that you can borrow to buy a car, a house, finance an LBO, just finance your business on a day-to-day basis. And as long as there's the debt available at a price you're willing to pay, then the whole system works pretty well. What happens during a credit crisis or a credit freeze is that availability of debt capital just dries up. Can't get it. You can get it at exorbitant rates of interest, but most people won't pay that exorbitant rate of interest. So just pass on the purchase, pass on doing the deal, pass on the refinancing, whatever it is. And the markets. I mean, one of the reasons I love the debt markets is because it shares so much information with you so quickly about risk. It's a place where sort of risk hangs out, and you can see it developing on a minute-to-minute basis. Like when it became apparent, and I especially love the high yield bond index because that's where high yield bonds, junk bonds are issued by companies with less than stellar credit rating, who have real risk to their credit, but can still get access to capital. That was the great innovation of Mike Milken at Drexel Burnham, providing capital to companies that otherwise wouldn't have been able to get it, and doing it in the junk bond market by issuing these bonds, publicly to a large extent. But they don't have AAA credit ratings. They often don't have investment grade credit ratings. They have below investment grade credit ratings, which means that they have to pay a higher rate of interest to borrow the money than say Johnson & Johnson would have to pay, or the government would have to pay, assuming we don't default on our debt, or we lift the debt ceiling, or we don't get too crazy, which we happen to be going through a crazy phase now, which is why everybody gets so nervous. And so when the yields in the junk bond market spike up, you really get the sense that people are really risk off, as they like to say on Wall Street, that they'll borrow money, or these companies can borrow money, but they really have to pay up for it. So what happens in the junk bond market can tell you so much about how people are feeling about risk. And last week, the yield in the junk bond market, which was already trending up because interest rates had been rising and people were worried about the economy generally, had been about 7.5%, leapt up to 8.5% like in a day or two. I mean, another huge jump in a very short period of time. So people are really nervous, and that's just the average junk bond. Some junk bonds are yielding 20% or more.
There's a general sense that last week that either intentionally using the debt markets as a weapon, and that is people are fed up with Trump and these sort of what they believe are reckless, mutually assured mutual destruction tariffs, and that the Japanese and potentially the Chinese went into the bond market, did some short, fairly abrupt pulsed sales that took the 10-year up to basically say, hey boss, you fuck with us, we're gonna fuck with you. Do you get the sense that's what happened?
Personally, I think that's what happened because it's a way to quietly fuck with us, if you will. Fuck with us. You're going to do these tariffs? Yes, we'll match you tariff for tariff. We'll play that long game. We've been around for 5,000 years. You've been around for 250. We'll play that long game with you. And in the meantime, we'll drive up the cost of money. Not only, because if you drive up the cost of the government borrowing,
repeating some Chinese propaganda here.
It costs more to refinance. It drives up your budget deficits. It drives up the cost of all other borrowings by corporations and individuals because bonds are priced off of a spread to treasuries, and while that spread had narrowed, then in the last few weeks it's widened again. So that's what I thought happened, Scott. And it was also like a signal that you need to refinance $6 trillion of treasury securities by June. We may not plan that, Scott Bessent, Treasury Secretary. So good luck trying to refinance at anything like 4.5% rate. It might be even higher. But the other day I noticed that Bessent came out and said that's not what happened. Personally, I'm not sure I believe anything that comes out of the Trump administration, so I don't know that I believe that. But something has to account for the largest move up in the 10-year bond in 37 years.
If you're a banker, if you were hired by the Chinese Communist Party, if you were hired by the CCP with a mandate of quietly, elegantly devastating the U.S. economy.
I can't tell if this is going to be a question or a comment.
Well, most of my questions are comments, just discussed. I think the Trump, before the thesis of Bill and I are friends, I think the Trump administration has vastly overplayed their hand and has absolutely no sense of how powerful or vulnerable we are. That if China wanted to, they could seriously fuck with us. That they could go into the market, sell their $700 billion in treasuries and spike the 10-year and maybe inspire just like a crazy thing. But they're not stupid. They realize that if they kneecap their third biggest trading partner behind EU and Asian nations, that would be bad for them. So they're showing more restraint than we are. Am I overestimating, underestimating their ability to wreak havoc on our economy, given that they're now kind of, I think, one of our largest creditors?
Yeah, I think they're our third largest creditor, with Japan being, I think, a bit bigger. So the two of them could certainly subtly send a message. And you're right, you don't want to dump your $760 billion worth of treasury securities because just like you wouldn't dump your big position in a stock in a company without a proper underwriting or dribbling it out over time, because that'll drive the price down, and you won't obviously get as much for them. But I think it was a very effective signal. Yes, the Americans buy a lot of goods from the Chinese, but look, they just said we're not going to sell you any more rare earth minerals. So they control the rare earth mineral market, and we need those rare earth minerals for all sorts of things. It's like electric cars for starters. So that's another way that they can be very effective in getting their message out. So to get back to your
rare
original
earth
observation,
too.
yes, of course.
Okay, that's two. One more, and it's it for this guy.
Conceivable way possible. I mean, even if you were like a Hollywood script writer, you could not possibly imagine this kind of scenario that Trump has come up with to, destroy or to begin to destroy the confidence that people have in our capital markets, which is, like you've talked about so often, Scott. With universities are, one of our greatest American assets. Another one of our great American assets is our financial markets. You ruin those. You ruin the confidence that people have in those financial markets. It's a self-inflicted wound.
We'll be right back.
Support for the show comes from public.com. Sometimes it feels like you have to be a wizard to be successful in the stock market. The truth is there's no innate skill to investing. You just have to find the right tools. Enter public.com. That's where you can invest in everything: stocks, options, bonds, and more. They even offer some of the highest yields in the industry, including the bond account's 6% or higher yield that remains locked in even if the Fed cuts rates. With Public, you can get the tools you need to help make informed investment decisions. Public is a FINRA-registered, SIPC insured, US-based company with a customer support team that actually cares. Bottom line, your investments deserve a platform that takes them as seriously as you do. Fund your account in 5 minutes or less at public.com/propg and get up to $10,000 when you transfer your old portfolio. That's public.com/propg. Paid for by Public Investing. All investing involves the risk of loss, including loss of principal. Brokerage services for US-listed registered securities, options, and bonds, and a self-directed account are offered by Public Investing Inc. Member FINRA and SIPC. Complete disclosures available at public.com/disclosures.
We're back with Property Markets. You talk about the idea that what we're seeing in the surge in these yields is a result of an action from the Chinese government, maybe the Japanese government, to fuck with us, as you said. And I feel like these are the two options here. It's either this one-off event-driven situation where the Chinese government has said, hey, we're going to dump our treasuries today just to remind you that you can't fuck with us, or it is a larger and more structural change where the entire world is turning away from the US debt markets, away from US treasuries, much like they're turning away from the US stock market. And in that case, what we could see is higher yields for even longer. And I think those are two very different paths, right? In one case, the yield spikes up and then it comes back down. In the other case, it continues to slide up and up and up. One is more of a one-off event, and the other is a structural change that's going to last for a long time. I'm wondering, in your view, which path you consider to be more likely? Is this just, a premature trying to intervene with Donald Trump, or is it a structural change and the world is turning away from US debt?
Honestly, both things can be true. I think both things can be happening.
Yep.
If you look at the 2008 financial crisis, it was caused by a huge flaw in the architecture of Wall Street. This whole idea that depository institutions, whether consumer deposits or institutional deposits, were borrowing short and lending long, and giving creditors. I mean, Bear Stearns at the end was borrowing in the overnight repo market, basically giving their creditors a vote every day, every night about whether to do business with them anymore. And finally, in March of 2008, they said, enough. I'm not doing this anymore. I'm not rolling over the $75 billion of overnight repo that you want. And basically, you're out of business. Same thing happened with Lehman, Merrill, almost happened with Morgan Stanley and Goldman Sachs. So that is an inherent flaw in the fractional banking system, in our banking system generally. We saw it again with Silicon Valley Bank and Republic Bank. So we have a basic flaw in the architecture of the system. But so that's why that happens. And that's why historically there's been financial crises in this country, usually once every 20 years. As a society, we've said, okay, we can live with a blow up once every 20 years because we like banks and private banks, and if we didn't have them, our economy would basically be tiny, and we wouldn't have the dynamism that we do in the economy, generally speaking. In 2020, we had the pandemic, which was an exogenous factor, freaked everybody out. Economies got shut down all around the world, concern for a recession. The Fed had to jump in and flood the zone again. And then in 2025, April 25, we have the actions of a single madman who happens to be in the White House, who can, by executive order, thanks to Congress's inability to seize back that right to implement tariffs or not. I'm still wondering why they haven't seized it back, but they've ceded this to the executive, and he's just going hog wild with it, loving being the center of attention, as we know. He himself is the one who is causing these fluctuations in the markets, this loss of confidence. So people are like thinking to themselves, this mad king, we don't have a parliamentary system. We can't vote him out of office. We can't have a vote of no confidence. We can't impeach him. We tried that twice. That doesn't seem to work. We're stuck with this guy for 4 years. So you're asking if this is a longer-term situation? The answer is, as long as Donald Trump is in the White House, and Congress does not take back the power of the tariffs, which is rightly theirs, which they don't seem to be in any hurry to do, this is why there's this massive loss of confidence. And once that confidence is lost, especially when it's a factor driven by this kind of a factor, it's going to be very hard to get it back. Not impossible. We got it back after 2008, even with the architectural flaws in the system. But this is such a self-inflicted wound. It doesn't have to happen. A normal person might say, okay, I had this idea, I was wrong, and now I'm going to correct it because I've seen the damage I've done. But we're dealing with somebody who never admits that they're wrong, and will never do something without trying to save face. And I don't know how you save face in this situation without just sort of abandoning the whole stupid idea to begin with.
The big question is ultimately, okay, then where does all the money go? Like, I think we could reframe it not necessarily in terms of alpha, but just as a basic question. If capital is leaving the US stock market, it's also leaving the US bond market, it's also leaving the US dollar. I mean, we've seen the dollar at a 3-year low compared to the euro. Then it has to go somewhere else. And I think the question we have to address is, where will the money go eventually if that rotation is to fully materialize? Does it go to Europe? Does it go to China or to gold or maybe even to Bitcoin? Maybe to other foreign debt markets? If you had to make a very long-term prediction as to where the money ultimately goes if this rotation materializes, what would you predict?
This is not completely black and white. There's a lot of shades of gray here. I mean, the money isn't leaving our bond markets or even our equity markets. What's happening is everything's being re-rated, everything's being repriced. So you can still get capital, which is why we're not yet in a credit crunch or credit freeze. You can still get capital. It's just going to cost you a lot more. You can still invest in NVIDIA. It's going to cost you a lot less. So, I mean, as Howard Marks said, the great distressed bond investor, he said, if suddenly you go into Bloomingdale's and everything's 25% off, you're not going to run out of the store and say, oh my God, I'm not going to buy anything. Everything's 25% off. you're going to say, oh, let me get out my shopping cart here and pull as much as I can that I wanted to buy and put it in there. So, the time to back up the dump truck in the equity markets is when there's a major correction, which is, why Warren Buffett moved into cash in such a big way at the end of last year and the beginning of this year, and now he's like 350 billion of cash. He's the only, if you look at the billionaire list, the Bloomberg billionaire list, which I love to look at, he's the only billionaire, I think, in the top 10 whose net worth has increased since the first of the year, and he's up like 25 billion because he's sitting on this pile of cash that's earning whatever it's earning, 4 or 5% in the bond market. So as usual, he's much more brilliant than everybody else, even though he's 92, 93, 94, not being ageist here, Scott. But I think that, it's just, we got the for sale sign on, and you can't catch a falling knife, so you have to be careful. It could get worse. But basically, the message always has been in the past, when markets correct, I always say that's a good thing, and that's a time to invest.
So I think the majority of the people, at least the circles we run in, think that this is, one, bad, but two, a lot of the damage has yet to be felt. Now, obviously, we see the markets because they get marked every day. But a lot of this damage, the way I would describe it is Trump pausing the tariffs has just pulled a knife halfway out of the back of the economy, but the damage is going to take years to heal. Any sense for where the next manifestations of this damage will pop up? Is it hiring? Is it more market tumult? Is it earnings calls? Is it reduction in tourism? Like, what are you waiting on for sort of the next card to be turned over?
Well, I think we're already seeing the reduction in tourism into this country from all over the world.
Yeah, it's huge.
Huge. It's fascinating. Really, I've never seen anything like that. The bankers I talk to, the M&A bankers I talk to, who are talking to gobs of CEOs, they're worried about earnings in the third and fourth quarter.
Yeah,
because they see inflation rising, tariffs being on, everything costing more, demand will start to be affected, and their earnings will be affected. That people like to say, well, the stock market isn't Main Street, and I get that concept, but it actually is related to Main Street in the sense that it's related to corporate earnings, which of course is related to Main Street. So there is very much a relationship between the two, and and as we know, the stock markets especially are forward looking, and I think part of the reason we've lost this 10 or 15% so quickly is because investors are saying, hey, these tariffs and the result of them, this loss of confidence and people holding onto their wallets, we are a consumer driven economy, and if the consumer closes the wallet, we're going to see a decline in earnings in the third and fourth quarter, and that's what I think CEOs are expecting, and that's why you're not seeing any M&A business on Wall Street or much financing business. All this anticipated regulatory relief that Trump was going to usher in is all for naught now, because he's screwed the pooch by destroying the confidence that we had in the markets and that corporate CEOs had in their own businesses, and they're just not going to do things when they don't know where all this is going to settle out.
William Cohen is a New York Times bestselling author, financial journalist, former M&A banker, and a founding partner of Puck, where he writes about what's really happening on Wall Street. I love Bill's newsletter. I highly recommend you go subscribe to Puck. It's really informative, and he keeps things spicy, which I appreciate, especially in financial news. Bill,
I have become obsessed.
Nah, not now. Oh, today wasn't so good. These guys are figuring me out here. But we can't show weakness, so gonna be a shit day. We're just gonna have to camp these guys for the entire duration. Oh, there's a post over here. Good, I cloaked up. Wonder what's gonna happen when what happens when I decloak? This thing gonna shoot me quickly, or? Pulse laser battery. Fall off 14, optimal 52. So we're safe from this thing. Cannot harm us. Yeah, we're safe actually. A squall. A red Mac. The red Mac has come over here. I'm pretty bored. I'm gonna go fight it. Shit, I'm gonna literally die. I just got muted like an idiot. I couldn't beat it. Is that one burned out? Did I run it for too long? He linked the kill. Not sure. I guess he's bragging about it. Because I have it too. Maybe maybe Z kill. And I don't know. Maybe they can scan the local chat. Maybe this is a way to upload your kill or something. I don't know. I'm hungry too. Need to get some food. I guess, good time anyway. Oh, it's getting late too. Almost 2 in the night. Alright, I'm gonna get some food and I guess I'm gonna get a spare interceptor out here to escort this guy home and repair. I didn't mean to burn out the modules. That was an accident. Oh, we should put the cloaking device in the middle. this thing burn out? They all have 40 HP.